Welcome to the Manitoba Ag Days podcast, where we hear from some of the most relevant, up-to-date, informational speakers in our industry. In episode 13, Todd Jenkins, MNP U.S. tax presentation, tells his story, the tax consequences of doing business in the United States.
Wow, thank you. Can you hear me? I can hear myself. Thank you very much for that. And we also do a lot of cross-border personal tax planning and compliance as well. So what I'm here today to talk about, as was indicated, the tax consequences of doing business in the U.S. I'll get on to the first slide. So just to outline the agenda, primarily we're going to talk about, as I say, overview of the tax consequences for a Canadian company doing business in the U.S., available penalties and interest that the IRS can assess, and we're going to talk about the compliance that needs to be done. Look at a couple of the recent initiatives that the IRS has in place with respect to foreign companies. And if we have time, I'll talk about the tax consequences of Canadians owning U.S. real property. But before I get onto the main program, I'd just like to change the slide here and talk a little bit about the recent U.S. tax reform. There's a couple of good things and bad things that impact Canadian individuals and companies with respect to reform. Obviously, the first one, which is hugely beneficial. I'm going to do my Trump, huge. It's a reduction in the corporate rate. Historically, the U.S. corporate tax rate was the highest, one of the highest in the world. And obviously, you've heard the rhetoric. Trump's talking about, well, we've got to reduce the corporate rate to stop countries from flowing out of the country. And I think he's done just that. So what he's done is reduce the top federal rate from 35% to 21%. So the combined federal and state tax rate used to be roughly 40% in the U.S. Compare that to 27% in Canada or less if you're taking the lower rate. So that's a benefit if you are actually, again, all of these discussion points here are for U.S. companies that are actually subject to tax in the U.S., and we'll talk a little bit about that later. So the number one, the corporate tax rate reduction, that is a real benefit for the U.S. economy, and it's going to be a big benefit for Canadians doing business in the U.S. Another benefit, I don't know why it came out in red there. Oop, wrong slide there. The 100% expensing of capital additions and assets. Historically, whenever a company made a capital improvement, not capital improvement, but capital addition, machinery and equipment, it's basically that you're required to amortize it over a period of years, 5 to 7 years. For the next couple of years, it'll be 100% expensing in the year paid. So that, again, that's a big benefit that wasn't otherwise there. And number 1 and 2 are designed, obviously, to spur on the U.S. economy. Number 3, this is a little bit of a, it can be good, it can be bad. So essentially, there was limitations for earnings stripping. For example, if a Canadian company had a U.S. sub, would charge interest and effectively extract profits out of the U.S. The IRS has put limitations on that. Essentially, you can only deduct interest in the U.S. Equal to no greater than 30% of your EBITDA. However, a good thing is for the smaller Canadian taxpayers and smaller U.S. taxpayers, these rules don't apply if you're under the $25 million threshold. So historically, with the higher U.S. tax rates and the lower Canadian rates, we used various structures to extract income out of that jurisdiction to lower the taxpayer's overall effective tax rate. Number 4, NOLs. Historically, just like in Canada, you can essentially, if your prior year NOLs exceed your taxable income for the current year, could essentially wipe out your current year taxable income. The IRS has restricted that to 80%, leaving 20% subject to your 21% tax rate. So that's not a great thing. A benefit of number 5 is, though, is a doubling of the unified credit for estate tax. As you may or may not know, whenever a Canadian individual dies owning U.S. real property, there's an estate tax that applies. And to the extent the value of that, fair value of that property exceeds $1 million, it's 40%. However, because of the Canada-U.S. treaty, Canadians are able to access a unified credit. So essentially, the unified credit before the change was $5.6 million per individual. Now it's doubled to $11.2 million. And what that means is that if you're an individual and you die owning U.S. real property, and your worldwide assets are less than $11.2 million, or if you double that if you're married, then you don't have to pay a state tax in the U.S. on that property. So that's a good thing. And essentially all we need to do is for the very high wealth individuals do estate planning, which again, this makes life easier for a lot of Canadians. So now we'll jump on to the main part of the program. Again, Canadian companies doing business in the U.S. I'm going to basically be talking about these three scenarios, and mostly the first two, the left one and the middle one. Essentially, the facts I'm going to lay out for purposes of the rest of this presentation is a Canadian company selling grains to the U.S., a U.S. customer, and title to that product transfers at their doorstep in the United States. That's going to be the premise for the whole presentation going forward. In the first situation, if we can argue the Canada-U.S. treaty applies, which we'll discuss in a bit, all that's required is, a U.S. filing, 1120F, but there's no federal tax to pay. So that's a good position to be in, and we try and plan into that situation. If you exceed those thresholds and you're in this situation, then typically what you have to do is pay tax on your net income. And if our taxpayers are in that situation or expected to be in that situation, oftentimes what we try to do is set them up in a CanCo, USCo structure. You notice I'm using left hand for CanCo, being our left-leaning ways, and right hand for U.S. companies, being the right. So essentially what we set up a CanCo, USCo, primarily for creditor proofing, for Buy American and all this sort of stuff, and to essentially shelter the Canadian company from U.S. tax. It used to be prohibitive or inefficient when U.S. tax rates are higher, meaning the taxation of the money in the U.S. and gradually bringing it back to Canada, but with the reduction in the U.S. corporate rates, it's becoming a little more efficient to do. So next step, we'll take a look at, from purely a U.S. tax lens, what does it take to be subject to U.S. tax? Well, it requires two of these things. The first one, a trade or business, and that's a really low threshold. I have a slide on that. All it really means is that you have U.S. customers. So if you have a trade or business under U.S. rules, you're technically supposed to file a return just to let them know you're there. If you have a trade or business and effectively connected income, then you're in the second diagram here, the middle diagram. You're technically, under U.S. tax rules, required to file your tax return and pay tax on your net income. What's effectively connected income? In my situation where I have a grain farmer shipping grain into the U.S., title transferring into the U.S., the title transferring in the U.S. is the effectively connected income. So we've got a trade or business, Canadian company with U.S. customers, and then title transfers in the U.S. Under U.S. domestic law, if we're looking at that lens, we have a tax filing obligation and a potentially tax payment obligation to the extent there's taxable income. A couple examples going back to U.S. trade or business. Obviously, typical things that we do, our clients do, personal services performed in the U.S., sale of goods to the U.S., having salespeople in the U.S., manufacturing, or a lot of procurement. If you do a lot of purchasing in the U.S., that can be treated as a trade or business. Again, very low threshold here, but what that does, again, technically under U.S. tax rules, if you have a trade or business, you're required to file a return. And again, if you have more of a substantive transaction, for example, title to that product transferring in the U.S., you have to file a U.S. tax return and report your net income to the U.S. So typically, let's say we're in the middle diagram here and we're saying, okay, or we're contemplating, or our client's contemplating going into that, going to be taxable. What do we do? Well, we look to the Canada-U.S. treaty to see if we can plan into that. And well, what's the relevance of that? The Canada-U.S. treaty essentially raises the threshold of activity, essentially allows a Canadian company to do more in the U.S. that would otherwise be subject to tax had the treaty not been in existence. And for purposes of treaty speak, we talk about permanent establishment. So if the company does not have a permanent establishment, we're in the first diagram, we just have to do a filing and reporting. If the customer has a U.S. permanent establishment, meaning you have a more permanent connection with the U.S., which again is a tougher threshold to meet under the treaty, then you're in the middle diagram, you have to pay tax. Quickly, what's a permanent establishment? Essentially, sort of under the treaty, connotes some sort of permanence, an office, a branch, a factory. This is old language, a workshop. If you if you use somebody else's office for your business, even a couple of days a week, you have a dedicated desk there, that's considered a permanent establishment and will subject your company to tax. Concluding contracts in the U.S., that subjects your company to tax. Agent, again, here's your agents soliciting contracts. Spending too much time performing services in the U.S. triggers a U.S. tax consequence. We typically don't see a lot of that. What doesn't trigger a permanent establishment, which you're allowed to do, you can have individual independent contractors soliciting clients for you, and as long as the contracts are essentially executed, signed in Canada, again, that pulls you out of the PE and puts you into diagram 1. And you can, for example, in this slide, you can actually store inventory in the States, in the US, like in a cross-docking situation without triggering a permanent establishment. One thing you have to be worried about, though, if we plan ourselves into the treaty or if we're there, meaning we don't pay federal tax, we have to be worried or conscious of the activities we do in the US. The more activities you do, chances are you're sliding down the scale to creating a PE and being subject to US tax. Here's, I guess, the backdrop of some examples I'm going to use. Not so relevant now that the corporate rate has reduced, but you'll see the U.S. federal income tax rate has dropped substantially there. But I'm just going to go over a couple of the examples again, just to reinforce what we talked about. So again, we've got a Canadian company shipping goods, shipping grains to a U.S. customer, title to those grains, to that grain transfers at the silo in the U.S. or the processing plant in the U.S. Under U.S. rules, typical U.S. rules, filing obligation, under U.S. rules, you have to pay tax on that income. Then we go back to the Canada-U.S. treaty. Well, how did you make that sale? Well, Canco doesn't have an office. It doesn't conclude contracts in the U.S. And in this case, doesn't even store inventory. So the key point here is the red writing up here is that, I don't know, that's not working. But anyway, the fact that the contracts are signed in Canada. So in this instant, the contracts are signed in Canada, notwithstanding we meet the domestic laws, you have to file a return, but you're not subject to federal tax. Good answer. Because nobody wants to pay tax to the IRS. Or nobody wants to have a refund coming back from the IRS because it takes forever. Same example, but we're in this example, again, Canadian company shipping grain into the U.S., title transfer in the U.S., but this particular taxpayer does it a little differently. He goes down or drives his truck across the border, shakes a hand in the U.S., concludes a contract down there, lost all the benefits of the treaty, has to file a U.S. tax return and pay tax on that. So subtle differences. We can help you plan your activities. Again, not everybody can operate in this instance. If we're in this scenario, in the second scenario, which we call a branch, then we determine whether or not it makes sense to incorporate. Filing obligations. As I indicated, under the first diagram, if you have a you have a trade or business, you're supposed to file. Often people don't if you just have a trade or business. They only wait until you actually earn revenues. So essentially, if you have a trade or business, you're supposed to file, and clearly you add more activities, you conclude contracts, you're required to file this return. And again, what it is, it's a U.S. corporation designed for foreign companies. If we're arguing the treaty applies and we don't have a PE, then we have to attach this 8833, and all that does is it discloses to the IRS. You're required to let them know, number one, that you're down there, you have to file a return, and you have to let them know, number two, why you're not subject to tax. So you have to attach this statement together with all the verbiage. Point to note, there is a monetary, if you're taking a position that the Canada-U.S. treaty applies, there's a penalty for failure to disclose that, $10,000 per filing. In my years of practice, I've been practicing over 20 years, never seen that penalty applied. It's been on the books, I think, since '86. However, going forward under the new Trump IRS, I think this is something they're going to use as a stick, and you'll see why later because of certain initiatives they got going on. Last point, the statute doesn't run until you file a return. So if you have a filing obligation, it makes sense to file it. For example, there's a 3-year statute. If my return is due today, with a day after a 3-year period expiration, the IRS can no longer look at that year. If you never file, it's always open to their scrutiny. Let's say we're in this situation, which is the middle situation here. I'm going all the way back. The middle situation here. So let's say we've exceeded the benefits of the treaty. We can't take advantage of it. We conclude contracts in the U.S. Here's this diagram here. We're subject to U.S. tax. Let's say that taxpayer doesn't file a U.S. tax return. What can happen? Well, expense disallowance. The IRS has a rule that basically says if you, foreign company, do business required to pay tax on your income in the U.S., you do not timely file your return, and timely file for this purpose only is 18 months of the original due date, which essentially translates to 21 and a half months of the year end. If they fail to file within that time frame, they're going to deny your deductions and tax you on your gross receipts. You'll see a case mentioned here. I'll explain that in a minute. Let's go just to see how ugly this really is. Let's assume we've got a taxpayer, $5 million gross receipts, $4 million of U.S. source expenses. If they file the return on time, they're supposed to pay tax on the $1 million. So the tax rate, this is only a federal rule. The federal tax rate is 21%, $210,000 tax if I paid on time, filed on time. If I didn't file a return, I missed that 18-month threshold, they tax you 21% of the $5.5 million. So that's a pretty big hit. You'll see the tax exceeds the amount of net income. And the reason I have this Swallows case listed here, back in 2006, there was a case, again, Swallows had investments in the U.S., was required to file. It didn't. Had that company filed timely, it would have paid $10,000 a year. But because they didn't, the IRS used it as a test case, and they got hit with that same penalty. So this is a big stick they have, and they're not, obviously, since 2006, they're not afraid to use it. So it goes back to the importance of filing. This form here, if we go back to the Canadian company, now we've got lots of activities in the U.S. We want to expand, we want to manufacture or just blitz the marketplace. We want to promote Buy American, we want to protect our Canadian company, so we set up a U.S. subsidiary. So typically, between companies, whenever you've got this scenario, there's transactions that go between the companies, whether it be intercompany loans, purchases, services, or whatever. This form 5472 is required to be attached to the 1120. So now take a step back. We've got a Canadian company, wholly owns a U.S. sub. The Canadian company no longer has to file. Now it's the U.S. company. That's how we've set it up. But this company has to file an 1120, report its net income, subject to 21% tax, subject to state tax rate. And because it's got all these transactions with the Canadian parent, has to report those on this form 5472. And the form number doesn't really mean anything, but the fact that you have to report these transactions, it's a pure disclosure item. Failure to file this, or even 1 day late, will trigger a $10,000 penalty. The IRS has been assessing these $10,000 penalties under the Obama administration since 2012. It's getting more difficult to fight them. We're still on the winning end, but depending upon, it all goes back to the client facts, whether or not we can reduce the penalty or eliminate it altogether. And this is why I'm saying that the IRS is starting to use these penalties that they have on the books. That's when we go back to the $10,000 penalty for failure to file a treaty-based return. I think they're going to start assessing those as well. Back to IRS activities. This time last year, under 2 weeks before Trump became president, the IRS issued this initiative indicating that they're going after foreign companies. Who's a foreign company? Who does the most trade? Well, Canadians. So they're looking for Canadian companies to make sure they're filing their tax returns, if they're doing it correctly or not. What does that mean? Well, we really don't know what that means. I haven't seen any statistics on what they found or not as of yet. But one can imagine that, for example, if you don't file a return and you're supposed to pay tax, they'll assess you with that gross penalty, gross receipts penalty, which can be enormous because you've never filed a return to start the statute running. And who knows, depending upon the connection between Homeland Security and the IRS, technology is getting better all the time. Sharing of information is getting better all the time. Could they turn you away? We don't know yet. So the moral of the story here, it's cheaper to file. You don't want to pay us to fight that battle. It's easier just to file the return and start the statute. Another one with respect to transfer pricing, this involves a Canadian company, U.S. sub scenario, and essentially they want to there's rules around what each side can charge. Canada has transfer pricing rules, the U.S. has transfer pricing rules, and all this campaign does is they're trying to make sure, they're looking at the transfer pricing policies to make sure Canadian companies aren't arbitrarily pushing profits back into Canada more than they should. So that's another initiative. Lastly, which I haven't got a slide here for U.S. citizens living in Canada are required to file returns in the U.S. regardless, even if they've never stepped foot in the U.S., never earned a dollar. The IRS is looking for U.S. citizens who are non-filers. There's currently a program out there. The IRS is trying to encourage people to come forward, and we're doing a lot of those filings. We call it a streamlined filing program. And it's sort of like a voluntary disclosure. It brings the taxpayer in without penalties. Penalties can apply not with respect to the U.S. tax, but with respect to a whole bunch of foreign filings that have to be made. I'll touch briefly on state taxation. Whenever you're dealing with U.S. tax, you have to think about state tax. State tax is based on the concept of nexus. What does that really mean? It really means a physical presence, the minimal presence with that state, allowing them to subject you to their tax liabilities, usually physical, individual, independent contractor, sales agent, truck, inventory. Any of those things can trigger a filing obligation. I like to use the example of Michigan. I recently looked at that. One day in Michigan on behalf of a Canadian company can trigger a filing obligation in Michigan. It's that ridiculous. So if we're in the first situation, let's say we're in a treaty-based position, we argue, yeah, you've got a trade or business in the U.S., but we're taking a position under the treaty for federal purposes that we don't have to pay tax. We're filing a return. Well, then we look to the states. What do we have to do for state tax purposes? Most states follow the treaty. North Dakota is one such state that does not. So, for example, even though I may be exempt on my sale of grains to the U.S. because I conclude the contracts in the U.S., but if I have a salesman in North Dakota, that triggers a nexus in North Dakota and a filing obligation and tax payment obligation, notwithstanding I don't have to pay federal tax. And just as an aside, North Dakota is pretty aggressive. More importantly, if you're transferring widgets or some sort of taxable, tangible property to the U.S. and you have nexus in that state, the treaty doesn't protect you. If you have a sales tax collection and obligation, if you have nexus, it typically triggers a sales tax collection and remittance obligation. You're on the hook for that, so you ought to be aware of that. Typically, it doesn't come into play if you're selling to a processor or something to that effect. So that's that part of it. I'll talk briefly, I have a couple more minutes, I'll talk briefly about Canadians owning U.S. real property. Typically, as a Canadian, this impacts us all individually or corporately. Typically, there's no tax consequences, income tax consequences, that is, unless you rent the property or you sell it. So you can have a vacation property, no problem, you enjoy it. Typically, if you're going to rent the property, what you'll likely want to do is elect to file a tax return. Why is that? Because rent is considered passive income, and whenever a U.S. person makes a payment of passive income to a foreign person, there's a 30% withholding. So if your weekly or monthly rent is $1,000, they will, if you do nothing, they're required to withhold $300 of that and send that to the IRS. And that's your tax liability. It's up to you to file a return to try and get it back. However, with rentals, there's an election to file a return, and what that does is it gives you the option to take all your deductions and grind down the income, typically to a negative, and certainly reduces your tax liability therein. So most taxpayers actually who have rentals file U.S. tax returns, and to the extent you're generating losses each year, your rent minus your property expenses, your mortgage interest and all that, you can use those losses to offset your gains when you sell the property. So here's generally the rule. You'll need an identification number to both file a return, and typically you'll give the withholding agent, the person paying the rent, this form W-8 ECI, and what that does is it tells them you don't have to withhold because I'm going to file a tax return, and then you file your 1040-NR, which is the tax return to report this. Sales of U.S. real property. Whenever a Canadian sells U.S. property, real property, no matter what it is, there is a mandatory 15% withholding. So if you're selling property worth $1 million, doesn't matter what your gain is, if you do nothing, there's going to be $150,000 taken out, sent to the IRS, and you'll get the difference. There's ways to mitigate that, to reduce that, a couple of them here. For example, if you're selling a place for $300K or less, and the purchaser is going to certify that they're going to use it as a principal residence, there's no withholding, but there's paperwork that needs to change hands. Between 300 and a million, same situation, reduce it to 15 to 10% withholding. And the biggest one is the last one. We do a lot of these. In my example, say I've got a property selling for $1 million, so the withholding 15% would be $150,000. Let's say my basis with all my costs, I reduce the actual tax liability to $20K. So if I do nothing, the withholding agent, the purchaser, is required to withhold 15% and send that to the IRS. If I apply for a withholding certificate before the close and I let the escrow agent know about it, I can oftentimes reduce the amount that goes to the IRS. So typically what happens is I prepare the forms, let the escrow agent know about it. Sometimes they like to file them, sometimes not. We send it to the IRS. And let's say that form says my tax liability is going to be $20,000. The IRS will respond within 90 to 120 days. Let's say they agree with my calculation. What will happen is, again, take a step back. The escrow agent right out of the gate is required to withhold $150. But if he knows I'm filing this application, he'll stick it in escrow. He won't send it to the IRS. I'll make the application. 90 to 120 days, it comes back. Let's say the IRS agrees that your tax liability is only going to be 20 grand. So therefore, they'll tell the escrow agent, out of that 150, give us 20, give the remainder back to the individual. So that's it. The key with this is you've got to let your escrow agent know before close, because if not, he'll just withhold and remit. And then you have to wait about a year to get it back. And why I say that, there's an obligation, notwithstanding there's withholding. The year following, you've got to close your obligations out in the U.S., you file a U.S. tax return, reporting your gain, your loss. If there's excess withholdings, you take that as a credit, get your refund then. It's oftentimes quicker to get the refund if you do the withholding certificate, and it all depends upon what the amounts are. If you're talking 130 grand, it's worth it. If you're only talking a few $1,000s difference, it may not be worth going through the process. You just get it back when you file your return. So I think we're there. Any questions? Excellent. I'm going to play with this thing for a while.
We do have a minute for any questions if anybody has a quick question.
As long as you are concluding the contract, you, the Canadian company, or on behalf of the Canadian company, is concluding your piece of the contract in Canada, you're good. It's if you're physically going down there, or let's say you have an agent down there, you have an employee that goes down there and essentially concludes the contract, but says, okay, we got a good deal here, but send it back to Canada. The IRS looks skeptically on that. If you can, in all cases, conclude everything and show proof that you're concluding in Canada, you're in pretty good shape. And you probably need a treaty-based return.
Thank you very much. With that, to keep our schedule on time, I'd like to, if everyone could join me in thanking Todd Jenkins with Myers Norris Penny. Thank you very much.
Thanks for tuning in to the Manitoba Ag Days podcast. We'll see you next year from January 22nd to 24th, 2019.